I'm Darren Farwell of the Farwell Group with Scotia Wealth Management, and this series was created to help you find financial freedom. In each video, we discuss topics relevant to you and your life. Be sure to subscribe to our channel and click the bell below to receive notifications of new videos. As always, if you have any questions or topics you'd like to cover in upcoming videos, be sure to comment below to be featured. Now, let's dive in today. In today's episode, we'll explain where to save first, RRSP or tax-free savings account. For many starting out in the world of investing, it's a common question being asked. There are many strategies you can utilize, even with a lower amount to invest, and we're here to share those and help equip you with the right tools and strategies to increase the amount of money you have to save and invest. Let's first take a look at where you can invest your money. You can invest in an RRSP, you can invest in a tax-free savings account, you can invest in a registered educational savings plan for those who have children. You can buy insurance as an investment. Many companies have stock purchases plans that you can invest into. An important question, and I get it a lot from young investors like you, when trying to determine just where to invest first. Should I invest in an RRSP or a tax-free savings account? Both are good. This is the right question to ask as you establish your own roadmap to financial freedom. Let's take a look at a young couple I've worked with, Jessica and Matthew. As a prudent wealth manager, I suggested they each do their maximum RRSP contribution and their maximum tax-free savings account contributions. That's currently 18% of your T4 earned income for RRSPs, and this year it's $6,000 for your tax-free savings account. Jessica and Matthew rolled their eyes at this advice because they had just bought a condo in 2021, they have a dog with vet bills, and are expecting their first child in 4 months. So at the moment, they felt that saving anything above and beyond these expenses would really be impossible. However, after some discussion and planning, we found a way to do the single most important thing: get started. Jessica could contribute some of her salary to her company defined contribution plan. When Jessica contributes 3% to her defined contribution pension plan, her employer matches her savings with another 5%. That's a good start. Jessica's already on track for 8% of the 18% she's allowed to contribute to her RRSP. Now, Matthew felt he could take $100 per month from his bank account automatically before he even sees it to contribute to his RRSP. This is called a pre-authorized checking plan. And on top of being an effective way to save, it's also a time-tested, proven formula for successful investing, known as dollar cost averaging. Because Jessica and Matthew are both making RRSP contributions, they can now anticipate getting a tax refund check, which they've committed to contributing a substantial portion of to their tax-free savings account. Voila, they can get the savings and feeling that they're working towards their financial freedom. It's important to note that each of these savings plans, tax-free savings account and RRSP, have pros and cons. We'll dig into that in a minute. However, an important advantage of the RRSP and tax-free savings account for any of you out there just getting started in this crazy real estate market is that these plans can both be helpful in slightly different ways in helping you buy your home. Let's start with the RRSP. Of course, the RRSP gives you a tax refund and it has tax-free growth. Two great things. Remember, with a home buyer's plan, you can access $35,000 of the amount in your RRSP to help purchase your home for the down payment of your home. And you can access that $35,000 for home buyers more than once in your lifetime as long as you've paid those funds off before or at the end of the 15-year period. Small disadvantage in that, though, is remember now that money you've taken out isn't compounding tax-free in your RRSP for the rest of your life. Using the tax-free savings account for deposit for a home is a good idea as well. It provides tax-free growth. There's no tax refund. But when it comes time to taking money out of your tax-free savings account, you don't have to pay tax. There are no penalties, and you can replace the money. As always, it's important to review the pros and cons of each of these approaches when you're considering using them to build or use for your real estate purchases. Each individual circumstance may call for a different plan of action. Now, let's dig in a little bit and look at the breakdown of each RRSP and tax-free savings account to determine which might be the right one to do first. Let's start with the tax-free savings account. As I mentioned earlier, there's no tax refund for your contributions. However, because of that, you can take it out, you can take money, do withdrawals from your tax-free savings account anytime you wish without paying tax or penalties. On top of that, you can replace the money you've taken out. So that's very powerful. Replace the money you've taken out, not only the money that was allowed as a contribution, but the earnings you made. You can put it all back in, just not in the same year. It's a very powerful savings tool, a real gift that we have for savings. The RSP. If you can invest long-term with a high degree of certainty, you should consider the RRSP because you're able to use a tax refund then to contribute to your tax-free savings account or even add more to your RRSP. For those with a lower income, let's say less than $40,000, that's generally what accountants say, you might decide to save your RRSP room for when you're making more money and your taxable income is higher. This is an especially important topic to discuss with your accountant if you own a business. It's also key to discuss this with them because they should be reviewing your personal tax situation before making any final decisions. Here are 3 additional questions you can ask ahead of chatting with an accountant or an advisor or even doing the thinking yourself. What is your taxable income and will you get a refund? If you won't be getting a refund, maybe you should save your RSP limit to later. Do you have a company matching plan? What are the details of the plan? Perhaps you should be contributing that on a regular basis. And what savings can you put away for the long term? How much might you actually need down the road? Because if you may need it down the road, tax-free savings account could be a better choice because it's easier to get out. Choosing between RSPs and tax-free savings account can be a complex decision, but using these can play a huge role in helping you find financial freedom. Just remember, it's not always about what you make, it's more about what you keep. By adjusting your expenses, lifestyle, and tax strategy, it is possible to invest, usually more and sooner than you might think. For more information on where to save first, RSP or tax-free savings account, be sure to check out the resources we've included in the description below. Finding financial freedom doesn't have to be a scary or overwhelming goal. Together, we can work to understand and break down each concept to help you achieve your own financial dreams. Finding financial freedom is possible and may be closer to reality than you ever imagined. Tune in next time as we share more tips and concepts. And don't forget to subscribe and click the bell below for notifications for future episodes. If you'd like to get in touch, please email us at the address below in the description. See you next time.